Good morning. Happy Wednesday. I want to talk quickly today about stock prices, share prices for publicly traded companies. I think this can be a cause for some confusion for new investors. So I wanted to talk a little bit today about some common misconceptions and some of the ways in which stock prices are determined and how they can be changed and manipulated. So I think a common misconception to start with is that, a higher price stock, well, that must represent a much larger company or a much more valuable company than a lower price stock. Not necessarily true at all. I'll give you an example. Microsoft, I don't know if a lot of you guys know, but they recently overtook Apple as the largest publicly traded company in the world. However, Microsoft stock, just looking here, is trading about $111 per share, whereas Apple's is $170 per share. And even Amazon is almost $1,700 per share, and that's smaller than both of those. So, out of that group of three, the largest company in there has the cheapest share price. So, don't be fooled. The price of a stock is not a direct reflection of the value of the underlying company. Another common misconception is that, if I buy a lower priced stock, I can buy more shares, and that way I can have larger returns than if I bought fewer shares of a higher priced stock. Again, not true. The accumulation in a share price is what determines your returns. So, if a $100 stock goes up 20% or a $2 stock goes up 20%, you've still made 20% of the capital that you invested. That's your gain. So another common misconception there, that, don't fall into that trap. There's also, I wanted to mention, one real tool that a lot of companies use to drastically manipulate their share price. I'm not talking about buybacks. That's been a hot topic recently with these tax cuts, companies going into the market and buying shares of their own company. That certainly has an effect on the stock price. But what I'm really referring to is stock splits. Splits can have an immediate and very drastic effect on the share price of a company. And the reason companies engage in stock splits is just because of the fallacies that I was just explaining. They know that new investors see lower priced stocks and they think, well, that's got to be a better value. No, I'd rather buy a cheaper stock because it's going to make me more money than an expensive stock. Or maybe they don't have $1,700 to invest to buy a share of Amazon. So they want to buy a stock that's $50. So how a stock split works, I'll just use Microsoft as an example. Let's just round it off. I know they're a little bit higher, but let's just say they're trading at $100 per share, and there's 100,000 shares available out there in the market. Well, if Microsoft's board comes together and determines, well, we would attract a lot more new investors if our share price was $50 instead of $100. Well, then they would do what's called a 1-for-2 stock split. So now instead of having 100,000 shares out there in the market, they multiply that by 2. So now they have 200,000 shares out there in the market. But now, instead of each share being worth $100, each share is worth $50. So if you were a pre-existing shareholder of Microsoft and you had one share at $100, well, now you have two shares, but they're each worth $50. So, the value of your brokerage account doesn't change. You still have $100 invested in Microsoft, but now you have two shares instead of one. So it can have a huge effect and a very immediate effect on the price of the stock. And a lot of companies that we all know, Coke, Apple, Microsoft, they've all done it a bunch of times to keep their stock price low to attract the new public investors. So there's one famous company that's refused to do it, and that's Warren Buffett's company, Berkshire Hathaway. He has refused since the start of his company to ever split his stock. He doesn't care about new investors. And that is why one share of Berkshire Hathaway, his company, one share is going to cost you $305,000. So he doesn't care about the new investors with, $1,200 to invest. He's keeping his stock price high. He's never done a split throughout its history. So the other thing, the other reason why I think companies, especially ones that are looking for new investors, look to keep their share prices low is that you can't buy, even after a split, you can't do this, but you can't buy fractional shares. So you can't go to Berkshire Hathaway and say, oh, I want, a 1/10 of a share. Or you can't go to Amazon's, and say, Amazon, I don't have $1,700, but, I have $850, so I want a half of a share. You can't accumulate fractional shares. Fractional share ownership is not possible except for one way. So even if after a stock split, you usually don't see fractional share ownership. So even if you have an odd number of shares and they do a split, you don't get half of a share or a third of a share. They will round it off for you, and they will put the balance back in your account. Though there is, like I said, one way that commonly results in fractional share ownership, and that is drip investing. I'll leave you with the question, see if anyone knows, what is drip investing? Hope everyone has a great day. Take care.